This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Is it common or very unusual for monetary and fiscal policies to want to head in a different direction?
I don't know that it's unusual, but in developed countries, it's perhaps unusual. In underdeveloped countries, perhaps less usual. But there is typically some attention paid to the coordination of monetary and fiscal policy. And of course, part of the intent in having the president appoint members of the Federal Open Market Committee or the Federal Reserve Board is to offer one place in which there can be some alignment between monetary and fiscal policy. Though there's also built into our system the desire to maintain some independence, a degree of independence.
Correct.
Monetary policy and fiscal policy. Because what you can do is get into a circumstance, which frankly we've been in, where where the monetary authority accumulates that debt to make fiscal policy more effective, at least in the short run. And here's a place, for example, that some people will refer to Keynesian economics, and Lord Keynes, who is an economist that was the one who put out the idea that in periods of economic downturn, the federal government should run deficits and increase aggregate demand in the economy to revitalize the productive processes and income generating processes that come along with that, and restore economic growth. The part of his admonitions which is ignored is he also said in the very short term, those budgets should be rebalanced.
Right.
Debt paid off. That part gets lost in Washington. So it's in a sense, a besmirching of his reputation that people accuse him of suggesting that we should have these large permanent deficits.
Yeah. Austerity was in his dictionary, but not in anyone else's.
Yeah, just a return to your point, a return of common sense to balancing the accounts.
So inflation's for 2021. What's the likely number, and is that going to be probably less in 2022?
The answer is about 5%, somewhere in the 5% range in 2021 and lower in 2022. I think our forecast is right around 5% total inflation headline in 2021. Part of that is, well, you're hearing the word transitory.
Yeah.
So I actually went to the Oxford English Dictionary, which is my source for the history of words.
Okay.
And definition of transitory is, in the first definition in the Oxford English Dictionary, is not permanent.
Okay.
That gives you a lot of leeway if you're the Fed. If you're saying inflation, the bulk of inflation is transitory, now you've sort of been released from a particular time frame, because it's over any time period. You can say, well, it's not permanent, it's just gone on for 5 years. Well, I don't think that's what it meant. We do believe certain parts of the inflation pickup it's a function of measuring the very significant downturn last year on a year-over-year basis. It makes it look very large.
Right.
Part of it is, but it is, from our perspective, not permanent. That is, the issues in the auto industry with the lack of access to the chips that go into the production of modern automobiles. That's a function of waiting until the production process for those chips rebounds, and then that will restore pricing. In fact, we would expect used car prices to actually fall subsequent to that, the restoration of that balance. The airline industry is pricing up ticket prices with the rebound in demand to recapitalize themselves after significant losses
Right.
with dramatic downturn. So that will stabilize at some point, which will see competition reemerge, and some of those ticket prices are likely to come back down. The same thing will over time be true in the hotel space. So those things I would say are fair game from the Fed's perspective in terms of transitory. There are other factors, however, that don't appear to be so transitory. For example, excuse me, the imbalance between labor supply and demand suggests that wage rate pressures are going to be strengthening, and that was the case in today's labor report. The hourly wage was up, I believe it was 0.4 from last month. That's pretty strong growth on an annualized basis, and we think that will persist for some time. It's also the case that housing, which is a significant piece of both the CPI and PCE measures of inflation, operates on a lagged basis, in part because rents only renew typically on an annual basis. So the fact that now picking up strongly won't be captured until over the course of the next year. That will be a substantive contribution to underlying inflation. And so our view is, while the Fed is targeting an average of 2% over some time frame, we think it's going to be higher than that. And our thought is for next year, it's probably around 3% and maybe the same going into 2022. And we'll see what Fed policy does in the interim. You've started to see the Fed board members comment that rates might change sooner than what they had been saying for a while. And I think it's a response to the real belief that not all of these factors are transitory.
I had an interesting experience buying a new car yesterday, and I've had another experience is building houses this year, and the price of a 2x4 went up 400%. But yesterday at the car dealership, I wasn't really intending to buy a car. I was getting an oil change, and we were thinking about buying a car in the next couple months. So I, meandered into the showroom and talked to a guy there, and nice guy. I said, you got a Q7? He says, we have one. You have one. You have one new car for sale. Yes.
Wow.
That was an unexpected. So, what's interesting about GDP growth is obviously their GDP growth they normally have a stock of 150 new cars.
Yeah.
So how do you sell cars that aren't there? And I said, okay, if I ordered one, what would be the time frame? For 4 months.
Right.
So, wow, that was just kind of a surprise that his industry was so impacted. I don't even know how you have a dealership open.
Right.
Other than used cars they have.
That's right. I have a friend who's a councilwoman here in Cape Coral, and she likes driving a Lincoln SUV. And so she was shopping all over the state of Florida to attempt to find the new Lincoln SUV and could not find it. And so she went online and actually built it from, you can build a car online now and order exactly the attributes that you want from a selection of things, and then they give you a delivery date and a price. So of course there's tremendous pricing power built into that because you're reflecting demand where there is actually at the present time no supply.
Yeah.
Increases the efficiency of production for the auto firm because they are exactly building inventory one-to-one to demand.
Right.
So there's a question with even when competition reemerges, whether that is going to represent a structural shift in the conduct of the auto industry. It'd be an interesting thing to see.
Kind of bigger picture question. I've been an adult since basically 1970. Got married around 70, and I was 18 years old. So I've had inflation as part of my vocabulary or experience my whole adult life. So here's a question: the time frame that I've been an adult, would you say that that type of inflation has benefited the asset holder equal to the wage earner, or was there a time frame where that changed? In other words, it just seemed like my salary and everything went up along with my asset prices for a considerable period of time, almost as an equal, and then there was a change. So the policy changed to where it really benefited the asset holder more than the wage earner.
First off, it's not clear that people would all agree that I'm an adult, so I'm not sure if I can answer that question directly. But set that aside. The answer is things changed, and if you look at return to capital versus return to labor, there was a shift in return to capital. To the advantage of the return to capital. It's part of the reason that you're hearing the debates publicly about the income distribution.
Right.
Because higher income households tend to own more capital and therefore generate more of the returns on that side. And monetary policy has actually benefited that in that when you lower the cost of capital through interest rates, for example, that actually benefits the holders of capital and the deployers of capital. So yes, there has been a shift, and there's a significant call for a reallocation of those returns. At present in Washington, it's through that urge is suggesting through deployment of income transfers,
right,
which is frankly pretty inefficient. Whereas you could change the rules in that govern the marketplace to allow the markets to do the reallocation, which would be a more efficient approach to making that adjustment.
The inflation of the 70s. So as I was buying a house and it went up, and as I was earning. So what caused the inflation of the 70s, and how is that different from today? So then we had some pretty high inflation.
Oh, we did, very high inflation. That was, you'll get various views on that. Part of it was monetary policy that was not disciplined with regard to managing inflation. It was more focused on supporting fiscal policy as opposed to maintaining independence and a sole focus on inflation. So, for example, if you compare the U.S. Central Bank, which has a dual mandate, which was put in place in 1968 by the Humphrey-Hawkins bill, which gave them a mandate to not only monitor and keep low the pace of inflation, but also to set conditions for maximum employment. If you look at the mandate of the German Central Bank, which went through hyperinflation post-World War II, they have one mandate, and that's zero inflation. So there's that rebalancing in 1968, the Humphrey-Hawkins bill, led to or supported what was already perhaps in train in the central bank focus on something other than just zero inflation. The fact that inflation got away from the Fed led to Paul Volcker, for example, who clearly focused on the issue of inflation and getting it under control, and did so masterfully. But it was, there may have been lip service paid to the employment side of the equation, but it was really about getting inflation back under control. We're at a position which could reflect a pivot point, and whether the central bank is heading back toward other social objectives other than maintaining control of inflation. So when you hear them talking about income distribution, well, one of the reasons that would be legitimate for them to talk about income distribution is that these low interest rates advantage some sectors of the population over others. For example, if you're already a homeowner, the fact that you can refinance the debt on your existing home for a small fee to 2.5% is quite an advantage in terms of wealth building for you.
Absolutely.
That cost dramatic. So that's an example of a have versus a have not. If you're an aspiring homeowner, the fact that home prices will have gone up some 28% in a 2-year time period is a disadvantage to you in terms of the affordability of getting into a home. So there's going to be discussion, I would argue, about Fed policy because it is not solely focused on the issue of inflation, and interest rates as a management tool are a very clumsy tool to affect other social objectives.
If I look at the financial paper today, 10-year T-bills at about 1.25.
Yeah, it's crazy.
What does that tell you? I mean, when you look at that, and especially if you have an historic perspective, and you have an economy growing at a pace that we are, you go, those two are not congruent numbers.
That's correct. And so a lot of discussion. I was in a meeting of a group of economists over the last couple of days, and someone asked the question or made the statement in the opening discussion. I would like someone in this meeting to be able to explain why the 10-year Treasury has fallen over the last few months from 1.8 to 1.2. And he got a resounding silence around the room. So the profession is not particularly erudite at explaining those things. One of the things that it could be is that the market is signaling we don't actually think growth prospects are that great.
That's what I was thinking. Yeah.
And that would be a very reasonable conclusion because so much of growth has been effectuated by transfers.
Right.
The transfers come to an end, will growth slow precipitously? And we definitely have growth slowing. This year, our expectation is somewhere in the neighborhood of 7% across the full year. Next year, something around the 3% or maybe even less than 3%, as all of that stimulus passes its way through the system, back out in the next couple of years beyond that to more in the 2% range. The other thing that it could be a sign of is financial repression. So if you looked up until about a year ago, I've lived in Cape Coral, Florida for a decade or more, and I came here in the depths of the 2007 to 10 downturn. And from the time that I was here out until the last year and a half or so, if you went through the grocery line, the bulk of the checkers and baggers were over 65. So you look at that and you say, why would that be the case? Because Florida's average age is actually not much different than the national average. There are certain pockets where there's older population, but on balance, Florida is actually not an old state from the distribution of its population. typically where I grew up, a lot of the baggers and checkers were younger people. They were working their way through college, or they were a second income or something like that.
Yeah.
If you're getting 100% on your passbook savings, and you thought you might be getting 3 to 5% on your passbook savings, then the amount of cash that you would have to have at 0.25% to throw off the returns to allow you to live the lifestyle that you expected you would get if rates were 3 to 5%, that's called financial repression. And the question is that simply the flip side of the coin of inflation? If you were getting 5%, but inflation was 5%, you're kind of back to that 0.5%, right?
Right.
Which is the reason for the focus on 0% inflation and being able to maintain your purchasing power, and forward interest rates being positive, signaling growth in economic activity.
Do you think there's a chance that we're going to have a bout of deflation let me just go down some categories and just maybe demographics for the U.S. Is that a deflationary, where we're at? Is that deflationary or inflationary?
Well, right at the moment, I haven't seen the most recent statistics, but given what I knew about where we were, say, 2 years ago versus where we are today, growth is in our population is pretty close to zero.
Right.
And if that were sustained for a period of time, then deflation would likely become a more likely phenomenon. I do think.
Does the age of population have affect that, like a Japan? I know they're much older in general, but.
Oh yeah, well, Japan is the poster child,
right?
Given that their birth rate is 1.3 and replacement is 2.1, so they're shrinking.
Yeah,
that is definitely deflationary.
Okay.
So that's one of the reasons why the adults in Washington are not calling for either the end of immigration or open gates, but rather a rational immigration policy, because our domestic birth rate is about 1.8. So without immigration, we will eventually come to a point where we're in a deflationary demographic profile. It's not the case today. Part of the question is, comes back to what you were saying earlier about, will the Fed at some point simply freeze the size of their portfolio and let the economy grow past it as a strategy for removing the QE portion delivered by the balance sheet, and then normalize interest rates? One clue to that is, in the most recent press conference, the Chair Powell did indicate that they're likely to start raising rates before they would make a change in the purchases in their portfolio. So that may be an indicator that might be their strategy.
Do you think things like artificial intelligence, is that inherently deflationary?
Not inherently. Though it certainly can have a deflationary impact in that it can reduce the cost of certain things by making them more efficient. And you're perhaps thinking here of big screen TVs, for example, where 10 years ago it would have cost, you wouldn't have been able to get a 70-inch flat screen. That didn't exist.
That's right.
When they did come into existence, they might have been $5,000. Today, they might be $750, and they give you two 28-inch screens as a gift when you go out the door. So that's deflation, and it's productive deflation.
Okay.
And that is one thing that you don't hear from some of our policymakers, is that there is productive deflation. That is, the advancement of technology lowers the cost of goods and services, which and if you maintain the value of our currency, it increases your purchasing power in the process. So it's not. They tend to focus, lead the public to believe that deflation from a financial markets perspective is actually the same as deflation driven by increases in productivity. Those are two different things.
We're pretty much out of time. I wanted to touch bases on being the reserve currency of the world. I'll probably just narrow it down to a couple of questions. So the United States has enjoyed that since officially right around the end of World War II?
Pretty much. Yep.
Okay. There's a history of countries losing that privilege.
Yep.
I mean, it's 100%.
Yep.
So is that a desired seat to sit in? And if so, why?
But it is, if you're cognizant of it and you protect it. It is a strategic objective of China to supplant the dollar as the world's reserve currency. Because then all the trades are structured in your currency. And from your perspective, it's much more financially efficient for you to be the dominant currency than to have to adjust to that of another hegemon. So it's something to be protected, and the current level at which we're expanding our deficits and outstanding debt work against that.
Okay. When we elect president, we have a vote. How do you have a vote to change a reserve currency?
Well, you have to vote for people whose economic policies would suggest growth as a priority over debt expansion.
Okay. But I mean, worldwide, how we wake up one morning and say, guess what? There was a vote and the dollar is no longer the reserve currency. So who in the world stage gets to determine that ultimately?
Oh, the global markets.
Okay.
It is the participant. We now operate in a global capital market. Ours is perhaps the deepest, most liquid and transparent of any around the world. But it's all the people who transact in ways that interface with that will ultimately make the vote on whether the dollar stays the reserve currency.
And how big of a factor is trust?
Oh, it's huge.
Okay.
We talked about that earlier on whether or not the U.S. would ever honor all of its treasury obligations. And if you start to see a deterioration of that in a rate rise or in the yields that can't be explained in other ways, that's probably a warning signal.
Okay. So just to wrap up, one other question. Your level of concern about hyperinflation, if it was a percentage, would be close to zero?
At the moment, I don't see hyperinflation as the issue. But I'm watching this discussion on infrastructure, and that's being talked about in the $1 trillion level. The share of it that's actually infrastructure is substantively less than that. But there's an attempt to tie that to another unfunded $3.5 trillion of spending, which to me is a real warning sign. That to me would be a negative for economic activity. Now you could get what Larry Summers has been arguing for some time, which is stagflation, such that increase in expenditures slows the private sector, but nonetheless stimulates demand in such a way that you get a significant growth in inflation at the same time as economic growth slows down.
Okay. Okay. Well, Doug, thank you so much for spending part of your time with us today. I appreciate it very much.
I always enjoy the conversation. You always come with good questions and stimulating things to think about. So I appreciate the invite.
Okay. All right, Doug. Have a great day.
Good talking to you. Okay.
Bye-bye.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.